Good afternoon, everybody. Thank you for the invitation, Juan and the Vinson Center. I'm going to summarize a paper that I've written, hopefully in 20 to 25 minutes. One of the mottos that I use is this one at the bottom here. This quotation from Milton Friedman that I found from a TV program that he was participating in as far back as 1976, which is an appropriate date for us. But monetary policy is not about interest rates. It's about the rate of growth of the quantity of money. And that's really the theme of the quantity theory, that it is a matter of the quantity, not the interest rate. And I'll say more about what the problem with interest rates is a little later on. The structure of my paper is as follows. I'm going to outline very briefly, and for this conference I'll keep it very brief, historical traditions of monetary theory, and then classify some significant current academic monetary analysis groups. And then what I really want to do is to apply those analyses to 4 different episodes where an attempt was made at implementing monetary policy in the US, in Germany, in the UK, and in Japan. And then finally, I'm going to assess whether a strictly monetarist policy in the current environment can really ever be implemented by central banks. So with that as background, we're really talking about a theory, which is the quantitative theory of money, and then whether or not that theory can be tested and how far it can be validated in the real world. My understanding of the theory, which of course goes back to the 15th and 16th centuries, is that most of the discussions up until the end of the 19th century, the early part of the 20th century, were entirely theoretical. And then they started to get data which they could actually apply. The theory was adapted to meet the requirements of the data in Cambridge and in Chicago, but mostly in the US. And then the testing was really only feasible once national income statistics in the US and the UK. This is not moving forward.
You have to do it on there.
No, it's on the screen there, but it's not.
I can't really stop.
Sorry, do you mind?
Susanna, can you? So, it's the good heart bug.
It has been disconnected before because the other speaker uses laptop and maybe
Maybe so that's
Why? Because it's a different sharing system.
Well, let me resume as much as I can without the slides. So basically, you had to have a theory, and then you had to have the data to apply to the theory. The data for the quantity theory of money is basically 3 parts: money itself, GDP, and prices. And prices have been available for a long time, but GDP data were really only developed in the 20s and 30s by people like Simon Kuznets in the United States, Colin Clark in the UK. And then people started to put them together to test the quantity theory. And that, as I say, they had to modify the theory. And the theory that became used was the Cambridge version of the quantity theory, Cambridge, UK, and it was also empirical work was also being done in the US. And the pioneers in the empirical work, I would say, were, so let me move forward. So that was testing the theory. And then, so the pioneers were people like Clark Warburton, Lachlan Curry, who wrote a paper on, he compiled monetary data as early as 1934. Clark Warburton, his work was mostly in the war years and immediately afterwards. And then Friedman and Schwartz and later the IMF built on that foundation. So you had to have the theory and the data, and you had to have all those kinds of data. And so the empirical work really didn't become possible until after the Second World War. Now, I don't want to spend time on the theory because a lot of people here who are not economists, but basically the economists went from a sort of MV equals PT formulation where M is money, V is velocity, P is prices, and T is all transactions covering goods, services, and assets, to a simpler version, MV equals PY, where Y is national income. So the sort of asset part of the equation was left out, and that led to some ability to make the theory tractable. It finally became possible to apply the theory generally to the economies. And obviously, the famous work is Friedman and Schwartz, but they were constantly referring back to the work of Clark Warburton, who had pretty much preceded them in most areas of research, and they acknowledged that in their book on the monetary history of the United States. So, that I think is kind of enough on the theory, because even today we still use the quantity theory, and we use it in this income form as opposed to what's often called the earlier version, the transactions form, which covers all kinds of transactions. Just going through the definition, this is important for the distinction between the groups of economists that I will mention. We need to say what constitutes money. And for the purpose of my paper, and I think the purpose for most economic research, nowadays money consists mainly of bank deposits and to a small extent cash currency. Cash currency, as you all know, is gradually diminishing as a proportion of usage for payments. But the sort of intuition is that nobody can spend without having money. Of course, you can borrow to buy things, but eventually you've got to repay the borrowing. The debt must be repaid. Now, I think it's important that on the demand side, money must include all types of money that can be used for purchases, whether this is assets, goods, services, or whatever. Now, the difference between the monetarist, and one difference between the monetarist and the Keynesians, is that Keynes didn't have access to this monetary data in the 1920s and early 1930s. And so he was searching for explanations for the Great Depression and how you might restore an economy. And he alighted on this idea that if you could boost certain types of expenditures, there was a multiplier relationship between those expenditures and overall expenditures, and that would generate a recovery in overall spending. The monetarists never bought into that and continued to focus on the monetary problems, both of the Great Depression and of subsequent fluctuations in the economy. And the first group that I want to deal with then in the modern world and the current world is those who advocate what is called broad money monetarism. And this would include Tim Congdon, who's probably the leader in this area, but a number of others. So here the focus is on broad money because it has a direct and fairly stable, although considerably lagged relation with nominal income or spending. Broad money consists principally of deposits, as I've said, plus cash currency held by the non-bank public. We exclude government deposits because governments do not or are not subject to a budget constraint. They can spend in short term whatever they want. So there's no behavioral relationship between the money they have and the spending they do. And shadow banks, non-bank financial institutions are also excluded. Now, broad money monetarists view the transactions conducted by money as consisting of two parts. There's day-to-day transactions for assets, goods and services, and money held as a part of a financial portfolio, which is important, certainly in financial institutions and among wealthier individuals. And it views the source of money as the credit counterparts, not the monetary base or high-powered money and a multiplier of that to create the total amount of money. It views the transmission mechanism, so broad monetarists view the transmission mechanism as starting with changes in money, quantity of money, and flowing through that MV equals YP equation, first impacting V, then output Y, and finally P prices. And if there are radical changes in V velocity, that's often because money itself is being manipulated, raised or lowered by the authorities. We have a good example during the COVID episode, both in the UK, the US, and elsewhere. The quantity of money was increased very rapidly and the economy was shut down. So that meant that in the ratio, in the velocity ratio, which is GNP divided by money, the GDP went down very sharply, so the numerator came down and the denominator went up very sharply. So we had a very steep plunge in velocity. And a number of people said, that just proves velocity is unstable. But that instability was induced by the actions of the authority. So that really is not a valid point if you're debating the stability of velocity. What really matters is whether velocity was going to return to the original value, that is the pre-COVID value. And what we see in most economies now is that it is indeed returning to the trend established pre-COVID. Now, the transmission mechanism of this broad money thesis looks something like this. If you have sustained and substantial changes in monetary growth, that will lead through a portfolio rebalancing to a change in asset prices, that in turn will lead to a change in spending by businesses and by consumers. And depending on whether it's an expansion of money or a contraction of money, that in turn will ultimately impact prices. So this is the transmission mechanism, and there's a lot of literature about this, which is worth looking into. And that transmission mechanism was described as early as by David Hume in the 18th century. So notice that interest rates do not feature on that diagram, and that's because initially, if you increase the quantity of money very rapidly, the first effect is for interest rates to fall. But later, as the economy picks up, as spending picks up, and as people want to borrow more and the inflation starts to pick up, then interest rates will rise. So within this chain, you get interest rates falling and then interest rates rising. So interest rates are not a good measure of the stance of monetary policy. It's always better to rely on the change in the rate of growth of the quantity of money. More fundamentally, interest rates are not the price of money. Interest rates are the price of borrowing money for a period of time. The price of money is what you can get for the money, or you could put it in terms of a foreign exchange rate. It's a fixed quantity of foreign money. So that's the chain. As you can see, it starts with monetary growth and goes through asset prices and so on. The Keynesians tend to focus on the last two boxes in the flowchart. They have a theory of real income determination, and then price changes, inflation, is a kind of an add-on at the end through something like a Phillips curve. Now, he's not here today, unfortunately, but Tim Congdon has refined this slightly in his new book, and it looks something like this. He talks about a direct effect of money on economic activity. So, for example, if the government hands out furlough checks, then that's the direct effect. But the indirect effect is what I was just discussing, the impact through asset prices. And then there are the notorious long and variable lags between changes in monetary growth, not changes in interest rates, changes in monetary growth and asset prices, economic activity, and goods and service prices. And one of the reasons why monetarism has had a bad name is because, given the variability of the lags, it's very difficult to generate good models with high correlation coefficients, because lags do vary and they're different from country to country or different from episode to episode. Those of us who are monetarists nevertheless believe that this is the underlying mechanism. It's simply a matter of figuring out where you are in the process. Now, there's a second school of monetarism today, which I describe in my paper as narrow monetarists, people who tend to rely on either M0, which is another word for it is the monetary base. That is basically the balance sheet of the central bank, the cash currency issued by the central bank plus the reserves of the banks. The theory here is that if the central bank wants to boost the amount of money in the economy, it will buy securities, boosting banks' reserves, and that in turn will boost the lending and activity by banks. Now, this feature or this view depends very much on. There's two issues here. One is, does M1 or M0, do they, M1 being money held by the public in the banks and the currency they hold? So it's a narrow definition of broad money. There's two issues here. One is M0 or M1 really the correct measure of money? Sometimes it has a good relation with spending, sometimes it doesn't. And there's quite a lot of episodes illustrating, especially recently since the global financial crisis, that relationship between narrow money, between M0 and broad money, is not a good one. So this money multiplier is really not very reliable. The idea that there's a constant relationship between the monetary base and broad money or spending. And then the second issue is really whether this definition, the focus on narrow money, is enough to generate an explanation of all the things that are happening in the economy. Most of the M1 demand deposits are used for transactions. It doesn't include generally the savings and time deposits, which are typically part of financial portfolios. So there are certainly problems in this usage of narrow money. And in my paper, I give the example of Alan Meltzer, who was a famous, well-known monetarist, worked a lot with the University of Chicago people that we were hearing about this morning. And after the global financial crisis, he criticized the Fed's QE program very severely, saying he knew of no country where the central bank had massively expanded its balance sheet or funded the federal deficit, which didn't result in inflation. Well, as we know, inflation was virtually non-existent between 2010 and 2019. It was below target. What went wrong there was the idea, he basically took the multiplier idea to the extreme, said because M0, the Fed's balance sheet, has gone up hugely, this must mean we're going to have very rapid growth of broad money or other kinds of money, and that will lead to inflation. But of course it didn't. And the reason it didn't was that the Fed was basically creating money because the banks were not creating money. The banks were in financial difficulty, they had to raise capital, they had to repair their balance sheets, and they were, if anything, tending to shrink their balance sheets. The Fed had to, so to speak, compensate for that. And that's the reason why you got a breakdown in this multiplier view. So in my paper, I'm critical of the narrow monetarists, and I have some more on that here. I don't think I need to go into that in any more detail. What about Friedman himself? Well, he was, I'd say, a bit eclectic. Earlier in his career, he tended to use M1 some of the time, M2 some of the time. And this is the explanation, or this is one of the explanations that he gave. Now, in the US, the Fed had a regulation Q which controlled the interest rate that banks could offer on time and savings deposits. And he says here, the difference in growth rates between the different money supply definitions arises solely as a result of a mistaken governmental policy with respect to Regulation Q. Regulation Q is a foolish regulation, blah, blah, blah. And it's Regulation Q which has limited the interest rates that may be payable. And then at the bottom here, over any period of the past, during which Regulation Q, that is the control of interest rates paid by banks on deposits, has not been of significant effect, there's been little difference in the relative behavior of different money supply totals. And so if you abolish or reduce the influence of Regulation Q, which of course was exactly in line with his pro-market philosophy, then it doesn't matter which of the monetary tokens you use. I think the objection is actually stronger than that to M1, but I thought it would be interesting to share with you his view. The third group that I talk about in my paper is the group that I call faux monetarists, false monetarists, economists who really do not rely on the quantitative theory of money. And they would include Austrian economists who tend to say that inflation is the increase in the money supply itself, but you seldom find any empirical work from them on that. The expectational and new classical monetarists led by people like Bob Lucas, Tom Sargent, and Neil Wallace. Market monetarists, Scott Sumner, David Beckworth, and Lars Christensen, and then marginally modern monetary theorists, whom I don't really rate at all. There are also in the business world a large group of people, including central banks, who use monetary and financial conditions indicators as their preferred indicators of monetary or macroeconomic policy. Now, I've done some research on these MCIs or FCIs, and they're only useful at best 50% of the time. That's because, like the objection to interest rates, they really only use interest rates or spreads. They don't use the quantity of money. That's all of the theoretical stuff. Let me turn briefly to the more interesting part, which is the application of the theory in different countries. The US tried to implement a monetarist theory.
John, would you be able to do it in 5 minutes?
Sure, okay.
Sorry?
The Fed.
What did you say, one?
The Fed, under Volcker, implemented monetarist policies. They'd had monetary targets before then, but they really have not been successful. As you can see from this chart, the actual growth rates mostly exceeded the target, or the targets. They had targets for M1, M2, and M3 in those days, and they were not successful. The basic problem was that in 1979, when Volcker became chairman of the Fed, his basic problem was that the FOMC members were very cautious about raising interest rates. What needed to happen was to break that psychology, take the interest rate decision out of the hands of FOMC members, and have a big jump in interest rates. And that's what effectively the decision to pursue quantitative targets resulted in. But there's no way you can say that Volcker was a monetarist. There's several statements you can find to the effect that he definitely was. The Bundesbank, for their part, also implemented monetary policy, monetary targets, but they tended to have a much more flexible approach and a longer-term approach, I would say. They were not trying to meet the target on a short-term basis. But if you look at the record, the variability of money was pretty high, both before German reunification and after. So they were able to keep prices lower than many other countries, but it's hardly a stellar recommendation. Then we had the history of the UK, which I've divided into 3 parts. And basically, Charles will know this history much better than me, but essentially it got off to a very bad start. Monitors have got off to a very bad start with competition and credit control and the early attempts to implement it. And then they moved to exchange rate targets, which obviously was not compatible with money targeting. And then in the 1990s, moved finally to inflation targeting, which I think has given the Bank of England too much freedom. Just one more experiment that I want to share with you, and that's the experience of Japan, where I think they did remarkably well. In 72, 73, 74, they'd had a huge inflation, not because of the oil crisis, but because they printed a lot of money. After that, they decided that they would control money, which they did, and the result was that when the second oil crisis came along, inflation was minimal. So this is what it looked like. M2 plus CDs, which was their instrument, gradually came down after 1974, and then and the GDP deflator, which is the gap between nominal and real GDP, also declined. They subsequently were driven off this by the Plaza Agreement, an agreement to manage exchange rates, and the Louvre Accord. So this decade of success between 1974 and 84 was derailed by a shift back to managing exchange rates. So let me close then with this. What's the feasibility of implementing monetarist policies? Well, in my opinion, it's pretty low at the moment, given that you really do not have any monetarist economists on the Federal Open Market Committee, in the Monetary Policy Committee of the Bank of England, or the ECB or the Bank of Japan. So monetarism has got to make better progress, even though, in my opinion, broad money monetarism has the best track record and the best theory, but nevertheless, it's not made a big enough impression on the economics profession. Now, broad money targeting, as I've said, was reasonably successfully implemented in Germany and Japan, and we'll have to do better winning the battle of ideas before monetarism has any chance with the FOMC or the Monetary Policy Committee here. If you're going to do it, I think the broad money targets need to be medium-term targets implemented over 6 to 12 months, not on a short-term basis as they were in the US, which led to all kinds of problems. And therefore, it's best to combine inflation targeting, that is using interest rates, with broad money guardrails, limits on money growth on the upside and on the downside, wide target ranges to prevent broad money overshoots, and appropriate accountability. If inflation is always and everywhere a monetary phenomenon, then it makes sense to try to control money either directly or indirectly. Thank you.